Welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions this evening are Ricus Reeders from PSG Hole-in-One Ruimsig and Wayne McCurrie from FNB Wealth Investments. If you'd like to send questions, please SMS us 41392 or email stockwatch@bdtv.co.za. Wayne, Ricus, good evening to you both. Wayne, I'll start with you tonight. It was a fairly muted day on the JSE today. Except for AB InBev, which was very welcome to see, I suppose, a long last jump in its share price after so long spent in the doldrums. What did you make of the results that they produced?
Well, look, I mean, just to talk quickly about the share price and the doldrums, they way overpaid for SA breweries, and they've been trying to swallow that for, is it 8 years now? Something like that?
Yeah, 2016.
And at long last, they seem to have their head coming above water on having paid too much for SAB. But just to come to the results, there are two trends here that I think are important to mention. I mean, firstly, beer volumes are still down, and this has been an ongoing trend now for a while. People aren't drinking as much beer. I think it's cyclical, fashionable. People are going for the premixes and lots of gin, all the different varieties of gin. So the other non-beer companies who are in the alcohol field, Diageo, etc., probably doing quite well. But, you know, beer's been around for a very long time and it's not disappearing. But it is still a bit concerning that volumes are down. But lucky enough, they could get margin, especially on their premium beers. And of course, they still got that Bud Light story, but that's now in the base. You know, and it's essentially the beer just almost disappeared because of that one ad when it went woke. But yes, it's good. Earnings are up 16%. Market wasn't expecting it. It was our best performing big share on the day.
Yeah. I mean, when you say the volumes were down, I suppose overall, but actually there were some record numbers in Brazil and South Africa. So we are clearly drinking our worries away.
So we are still drinking beer, yeah.
Ricus, are you tempted at all by AB InBev? You know,
locally, yes, and not because I think it's a brilliant company, but really, what else is there to buy in these South African markets? So, yeah, I'm very glad about the results. And as Wayne said, there still is problems in the beer market, but margin increase, and I think the overall sales also increased because the downward movements in beer volume was saved by, and as Wayne said, by the movement in the other drinks that they do. So at least with this kind of their results, the fears about their debt levels also a little bit down, and it showed in the price movement, not only locally but also overseas, both in Brussels and in New York.
Yeah. We've actually got an 8-year chart of the company now, so going back to 2016, and it's not been a great, it's as you say, it's been a woeful performer since. Are there any other drinks companies that you would look at, and would you put drinks companies in the same category as sort of smoking companies, or because these are they tend to be such big monoliths. So you have to extract margin because you're never going to get a massive increase in volumes because they've kind of built themselves into it's hard to get much bigger than what they are unless they buy something else. I mean, is there a good reason for owning these companies, Wayne?
Look, they're fairly steady earners. I mean, the tobacco companies up until, let's call it 5 years ago, they were also fairly steady earners, but the decline in volumes there has been significantly more than what the companies and the market was expecting. I mean, they truly are under pressure. I think the volume story on beer is a cyclical issue, as I said earlier on. And, you know, alcohol definitively hasn't got the same stigma and the same legislation against it and the same social pressure as smoking. I mean, you often go now to places and I'm a smoker, but you often go to places and you're the only smoker. You know, 10 years ago, that was definitively not the case. So, I mean, when you go to places now, you're not the only drinker, at least.
In fact, both of you are smokers, interestingly enough. So, but and not to, you know, necessarily hound you out of the room.
But you must remember, we're also only human,
Yes, no, that is true. Okay, so on to questions. There's a question on Anglo American, and the viewer says, I know Anglo has been on the program lately, but could your panel, Wayne if possible, comment on Anglo's current valuation? I'm asking as many guests on various shows have different opinions in this regard, ranging from full to 15% undervalued for only the copper part of the company. And also, will the buying of the Grangex iron ore mine have a bearing on the proposed BHP takeover bid? So, Wayne, starting with you.
I didn't catch the last part about the iron ore.
It said, will the buying of the Grangex iron ore mine have a bearing on the proposed BHP takeover bid?
Okay, look, just on the pricing of Anglos, I mean, who knows what the right price is for a share? You know, if there's a commodity upcycle, if you're paying 600, you're getting an absolute bargain. If there's no commodity upcycle, you are overpaying through your teeth. But let's just assume there is a commodity upcycle. Then I would tend to agree, I suppose, more or less with market consensus that 700, 750 is probably a better price for Anglos. And that's taking Kumba iron ore and Amplats at their current market value. So it's not taking in any upside on those two shares, because obviously they're just going to be unbundled, so they don't really come into the equation. Why they're not buying Kumba and they're getting other iron ore assets, I think is just a costing thing. You know, iron ore in South America and Australia and other parts of the world, they dig out the ground at a quarter, if not less than that, the cost of Kumba's iron ore. Kumba's iron ore is a very good grade, but in the downturn, Kumba goes into a loss situation very quickly. The other ones don't.
Ricus, I mean, would you absolutely be holding out for a higher offer, or would you be selling out now? Because what if a higher offer doesn't materialize?
Well, in a situation like this, and if you're uncertain, take a 50-50 approach. Sell half and keep the other half to see how it works out. That being said, I think, you know, if the price is right, the deal will go through. There's nothing, you know, everything has got a price. So even if somebody like Glencore steps in and makes a higher bid, great for shareholders. But I think in essence, whether this deal goes through or not, it has caused hopefully a rethink as far as management is concerned about what they should do with the company. So even if nothing happens, I think it might still be good news for a company whose execution of development hasn't been great when compared to the other majors, worldwide majors.
Has it really been that bad?
Yeah. I mean, they almost bankrupted the company with that acquisition in South America that Cynthia made. She bought it at the absolute top of the cycle. They've had huge problems with the infrastructure there. Yeah, I don't think they're atrocious, but yeah, some of their execution hasn't been good.
Okay, but just going back to the viewer's question, if a company is in play, do you have to have a keen sense of whether the company is fairly valued or not, or is it entirely out of your hands when a company is the acquiree and someone and others want it? If that makes sense.
I think the problem is this is a commodity company. And if you take a look at how one values commodity companies, it's a whole spreadsheet full of assumptions of which one might be correct in the end, but it's guesswork. So you can say that something is, when compared to other commodity companies at that point in the cycle, might be undervalued, but that's comparing them to another bunch of companies which you don't really know what the value is either, because it's a commodity company. You sell at the price that you can get, and you've got costs that you can probably manage to some extent, but not a heck of a lot. So it's very difficult to fundamentally value a commodity stream. That's why it's cyclical. That's why it's a trading instrument and not an investment vehicle.
Okay. Just a very basic question that's come in from a viewer, so presumably a newbie to the stock market, and he asks, how much money do you need to start buying shares? Wayne, is there any ideal number, or do you just have to start?
You just got to start. I mean, you can go in and buy individual shares. You'll need a couple of R1,000, 5,000 Rand, 10,000 Rand to buy individual shares, but you can start buying unit trusts and EFTs for much less than that, and then you get an exposure to a basket of shares. But it's like anything in life when you're starting out in something, just start. Try your best not to put all your eggs in one basket, because that can kill you. So try and get some diversification, but just start.
Ricus, anything, I mean, for example, easy equities, and I suppose this sounds like a punt because I own Purple shares, but you can have, they pioneered fractional share ownership. So making it a lot easier for people with smaller amounts of money to buy a portion of a share.
If I can lash on to that point, and I want to make 2 points, you're quite correct, because the biggest determinant of what your return is going to be is the cost of your investment, whether it be brokerage or an annual fee or whatever. So make sure that whatever you use to buy through, you don't lose a lot in costs. So that's the first point. And secondly, Wayne's quite correct, just make a start. But my main point is, and I'm thinking of my beloved, great, highly intelligent dad, and he got burned in 1969, 1970 in what was then a bubble, and he never really trusted the stock market again, unfortunately. So if you're a new investor, be prepared to take 25-30% loss on any investment. It is going to happen, but don't let that discourage you from being in the market, because in the long run you'll be okay.
Yeah, I think my father in about 2003 said, no, put your money in the bank rather than buy unit trust. So I missed out on an entire boom in the South African retail market for a long time. So I don't blame him, however. There's a question on Ferrari, which unfortunately would have been directed at David, but he is not here this evening. He is traveling to Australia to welcome his latest grandchild, I think. And the viewer says, one of David's favorites, in spite of its high multiple and price, but impressive last annual price appreciation, is this stock still worth a punt at this time? Ricus, would you have a look at this one?
Well, I don't follow Ferrari really, but I think the first point is, yes, I think it's trading at about a 60 historic price earnings. And secondly, people tend to think of Ferrari as the car, but it's not. It's the brand that's important. So in that sense, they're part of the luxury market. So one has to compare them with other luxury brands.
Okay.
But I would hesitate to have an opinion, because, as I said, it's not one of those that I follow.
Wayne, okay, so if you had to stack them up, say, against an LVMH or a Richemont, or I don't know if you would then draw a comparison between them and Porsche, would you say Ferrari's overpriced, or would you say that this thing is just unstoppable?
Look, I mean, Shapiro, if it's bottom left, top right, you just buy it. It doesn't matter what the valuation is. It doesn't matter what the price is. But in comparison to other luxury companies, this is expensive. I mean, it's probably double the rating that Richemont's on. This must be one of the most highly rated. The 60 price earnings ratio has got an enormous amount of good news built into it. Now, I must qualify and say the Ferraris that I don't own any anymore, but the Ferraris that I owned were all 70s and 80s Ferrari. You look cool in them, but they're not actually very nice cars.
No. And you don't want to drive them around Joburg, because a pothole will claim you in about maybe 200 meters, and that's it.
Yeah, and then you see, it's 8,000 Rand a tire, one.
Yeah. Okay, so it's expensive, so maybe we'll have to put this question to David when he's back in studio. Then there was a question on African Rainbow Capital Investments, and the viewer says the share spiked 10% yesterday and today, just after the opening. What is this? Are there any rumors going around? Because you and I had a brief chat about this before the show started. We haven't seen any news. What do you think might be behind that jump? Ricus?
Well, I certainly don't. I don't have a clue. Again, not something that I follow. I couldn't see any news coming out. So I think part of the positive move in the absence of news is just the market in general, where even mid caps and small caps are having a number of positive, or has had a number of positive days over the past week. I think it's basically on the lack of any global, specifically US news coming out this week, and on the back of pretty decent quarterly reports out of the US. So positive. So part of that's is possibly market momentum, but specifically, no idea.
Wayne, is this one that you look at? Because it's been a very disappointing performer since it came to market.
Yeah, I do actually look at it, and if you read their last set of results that came out, this is a heavy discount to what they determine the net asset value is at. So it's not, I mean, there's many companies, but this is rain and time bank, essentially. And there are no stories in the market that I know of. There's no rumors in the market that I know of. But anyone who believes their net asset value is significantly more than what the market is pricing has got to be prime for delisting and a takeout.
Yeah, okay. There was a question yesterday I saw from a viewer who was asking about Remgro. So it's not just African Rainbow Capital Investments. Remgro, yes, for example, trades at a 50% discount to its underlying assets.
Yeah, but Remgro, you need a lot more money to buy at Remgro than you do to buy at African Rainbow Capital.
This is true. Okay, there's a question from a viewer, and it's he says, I've got a solid sum in an Easy Equities RA spread between Allan Gray, Coronation, and 91 types, so all balanced type of risk. But I am concerned that if you add the Allan Gray type fees and then the Easy Equities fee, the combined fee is out of whack. If I go Signia, the all-up cost is less. Is this a real consideration, and should I rather keep to one and the benefits of fewer costs?
Look, I've had this story going on ever since I've been in investments. Is it passive investments better because of costs? And you can make any argument very valid depending on what time scale you use to evaluate passive investing to active investing. And active investing, you only use the average. So over time, the average manager underperforms the market after costs. But, the one nice thing about not owning an index is that if something goes wrong or you're worried about something and you've got an investment with an investment house, you can get hold of them. You can't phone an index. An index doesn't send you an email to try and reassure you of what's happening in the market. So I suppose it depends on your personality. To be honest, over time, I don't think there's one clearly defined winner between active management and passive management when it comes to the actual investment return. But obviously active management, there is an organization, a person that sits between you and the market, whereas in passive, there's no one sits there.
Yeah. Ricus, your thoughts? Is Signia a purely passive the investments, underlying investments, are they purely passive if you had to go for a Signia RA? Because I'm not clear about that.
I am not too sure, so I can't comment on that. But if I can refer to the previous question, the guy that asked whether he's, when he should invest, and I said, remember, costs are very, very important. So make sure that you're not overpaying, and if you can keep your cost of your investment down, you're already ahead. And then, if I can latch on to what Wayne said, yes, active management underperforms. I mean, there's more costs involved. It's as easy as that. But that cost that you pay is, and again, Wayne alluded to that, is the interaction that you can get with your active investment manager, like me or Wayne. And part of what we do is not to try and beat the market, but is to ensure that the client makes the best possible decision for his own circumstances. I'm there to stop people paying to build an unnecessary swimming pool. I'm there to help somebody who needs money right now, or who might need money 2 or 3 years from now, to take a look at that. There's a cost involved in that, but it helps the investor to manage his own money rather than relying on the market to do it for him.
Yeah.
Yeah.
And I
Now,
suppose, you know, the last
I've
point.
often said that.
Sorry, Wayne.
Yes, I've often said we actually counselors more so than investment managers.
Yeah. I suppose maybe the point that I haven't got across that clearly is whether or not you want to have an RA in one fund or spread across various funds, because you have the more funds you're in, the higher your costs go.
Look, if you're buying an RA into an underlying balanced portfolio, don't spread it too wide. As long as your actual underlying investments are quite well diversified, I don't think you've got to go to many other suppliers of the RA. I mean, all the companies mentioned there clearly are highly reputable companies with, over time, very good track records.
Yeah. And because it's election season, a viewer says, how well is one protected against an ANC EFF coalition owning a local ETF of, say, a Signia S&P 500 tracker? Fairly well protected, I would think.
Yeah, if the country, people will overstate this until the election's done and dusted. We've survived so many things in the past. We'll survive whatever outcome there is, we'll be there as well. So it's not as though our banking system, our asset management system, our asset managers are all going to implode and the money's going to disappear into some hole. That's not going to happen. So if you've got an underlying investment in the USA and the EFF and the ANC and the MK do form a coalition and the Rand bombs out, you're okay. You'll still have your money in the S&P 500. Even if it's with a local company.
Yeah. And Ricus, just on that point, I saw Katie Martin in the FT writing today, and she was talking about dollar strength. And she was saying there's an old adage among currency traders saying, buy dollars, wear diamonds. In other words, you'll do well out of buying dollars. Would that more broadly inform your decision to have an investment in an S&P 500 ETF, for example?
Yeah, in the end, as far as the global environment is concerned, everything revolves around the dollar. You can't get away from it. It's the reserve currency. It's going to be that way, I'm almost sure, in my lifetime. And probably, if you've got kids, your kids' lifetime. That's not going to be a sudden implosion. So yes, you've got to measure your local investment versus what you can get offshore. And most of the time, it's your American market that does best. There are times when emerging markets outperform. There are times when, geographically, the Far East will outperform, or Europe. But it tends to boil down to the Americans, and you cannot beat the American market or economy as far as their spread, diversification, technological advance, and wealth is concerned. So measure yourself against that.
Okay. And in the last minute, between the two of you, your stock picks. Wayne, what's your stock pick?
Yeah, I'm going for Disney. I know they came out with results yesterday and the market absolutely slammed them. But the streaming services, Disney Plus, quite a few of them have actually turned profitable, but it's more to do with the share price valuation. A lot of the other companies in streaming services, et cetera, have seen quite a good share price recovery. Disney really hasn't. So I'm going for Disney purely on a share price thing. The theme parks seem to be doing quite well. And the share, I think, is reasonably valued in comparison to the outlook. I mean, it's well off its highs. It's essentially half of what it was in the big boom. So, yeah, going for Disney.
Okay. And Ricus, how about you?
Something called L3 Harris. It's yet another defense company. They differ from the Lockheed Martins and the RTXs in that they don't make the big destructive machines or aircraft. They are technology focused. In other words, it's what comes in your cockpit. It's what technology is in your radio system. So they are providers to the bigger companies. 75% of their business is in the US. So they're fairly well supported there, but they've got the chance to export overseas. And the type of product technology they have is becoming very relevant in today's defense spending, which concentrates on technology rather than big killing machine. Forward price ending 16.5. I think they're cheap and they're in the right environment.
Okay. Gents, we'll leave it there. Thank you very much for joining us this evening. Ricus Reeders is from PSG Hole-in-One Ruimsig. McCurrie is from FNB Wealth and Investments. And up next, we have the close. Stay with us.